Executive English, Due Diligence versus Confirmatory, plus QofE. Welcome. In this quick session, you'll learn how to sound credible in finance interviews by speaking the language of diligence. We'll show you how to use precise terms so you don't overgeneralize or sound vague. Most importantly, you'll learn how to explain quality of earnings clearly, what it is, why it matters, and how it informs valuation and debt capacity. By the end, you'll have sharp phrases, concrete examples, and a confident tone that resonates with bankers, sponsors, and CFOs. Let's tighten your vocabulary and sharpen your explanations fast. Think of diligence as structured fact-finding to reduce uncertainty before investing or lending. Teams test risks, e.g., margin volatility, value drivers, pricing power, retention, and compliance, policies, controls. Work is organized into parallel work streams. Financial, quality of earnings, cash flow; legal, contracts, liabilities; commercial, market, competition; and tax, structuring, exposures. Each stream answers specific questions that roll up to a go-no-go decision and terms. Your job in interviews: show you understand the scope and how findings influence valuation, financing, and covenants. Early phase due diligence is hypothesis-driven. You explore open questions like, are gross margins sustainable? Or, is churn understated? You test assumptions with data and management interviews. Confirmatory diligence happens later to validate what's already agreed. The deal perimeter, the NWC peg, working capital mechanics, and debt-like items. The tone shifts from exploratory to verification. In interviews, signal the phase, we were pressure testing pricing lift, exploratory, versus we validated revenue cutoff and NWC definitions, confirmatory. Same toolkit, different objectives and language. Use focused verbs tied to the work stream. For example, we're diligencing revenue recognition, cutoff, returns, and deferrals against policy and audit trails. That tells bankers what you're testing and why it matters. Or, we're doing confirmatory work on NWC mechanics, AR aging thresholds, inventory reserves, and the PEG calculation. Avoid vague lines like, we're checking some numbers. Be specific about the document trail, policies, reconciliations, trial balance ties, and sample tests. Precise phrasing signals you understand scope, evidence, and impact on valuation and debt docs. Key areas bankers expect: quality of earnings. Is EBITDA truly repeatable? Look at revenue mix, recurring versus project, gross margin by product, and contract terms, net working capital, trend, seasonality, and AR/AP discipline. How this informs the PEG. EBITDA adjustments. Identify one-offs, restructuring, litigation, COVID grants, and policy changes. Customer concentration and churn. Top accounts, share, renewal behavior, and logo versus revenue churn. Tie each area to cash conversion and downside risk. Your narrative should connect findings to price, leverage, and covenants. A QofE normalizes earnings so buyers and lenders see the sustainable profitability of the business. You strip out non-recurring items, e.g., a one-time facility closure, remove non-core activities, side businesses, and adjust for policy or classification issues. The goal is to bridge from reported to sustainable EBITDA by making clear, supportable adjustments with backup schedules. Think of it as translating accounting results into economic reality. When done well, QofE clarifies what cash flow can support valuation, debt service, and covenant headroom after close. Use crisp, finance-first language. Example: We adjusted EBITDA for one-time items, legal settlement and CEO transition, raising sustainability by $1.2 million. Or, the run rate reflects post-close cost structure, vendor consolidation, and headcount plan, so margins expand 120 basis points. If policies changed, link timing to performance. Revenue recognition timing impacted margins in Q4. Deferrals moved revenue into Q1, not lost demand. Always tie adjustments to cash impact, predictability, and leverage capacity. Bankers want clarity, not spin. Steal these lines. Our confirmatory work validated the NWC peg. AR, aging, and inventory reserves matched the definition. The QofE supports X turns of leverage. Cash conversion and visibility justify the case. Sensitivity. Plus or minus 2% gross margin changes covenant headroom by roughly 0.3 turns. Manageable with pricing levers. Add one more. We isolated one-offs and policy changes to show sustainable EBITDA, improving lender confidence. Deliver them calmly, then be ready to walk through the backup. Schedules, samples, and ties to the trial balance.